This is PNC Roundtable.
Hello, this is Ric DeVore, Regional President for PNC Bank, and thank you for listening to PNC Roundtable. It's on this show that we tackle some of the region's tough issues with people who make a difference.
Now here's the PNC Roundtable.
Welcome into our PNC Roundtable. Along with Ric DeVore, the Regional President, Detroit and Southeast Michigan of PNC Bank, I'm Paul W. Smith, and today we catch up with Executive Vice President, Managing Executive Investments, James P. Dunigan. And I know you feel this way, Rick. It's great to have Jim back with us again. It was about a year ago.
Yeah, we had him here actually early in the year. It was a snow day, and I'm glad to report that today he did not bring bad weather with him.
A snow day in Michigan.
Yes,
think of
imagine
that. What are the chances? And you've just the other day I mentioned it on my morning show. The PNC just announced the results of its 28th annual Christmas Price Index survey. And for those who don't know, I'll start with you, Jim. Just what is the Christmas Price Index that PNC has been doing now for 28 years?
You're right, Paul. What we started 28 years ago was to price the items in the traditional Christmas classic, the 12 Days of Christmas. So we take those items and price them every year and created the PNC Christmas Price Index, which now not only provide we started it as a opportunity to engage clients at what was then a slow time of the year, and now use it to hopefully impart some economic insight and economic trends, and use that for educators in our website, www.pncchristmaspriceindex.com, where it's an interactive website where really children of all ages can go in and go through the 12 days of Christmas and see where those prices have gone over the years. And
it's fun, but it really is. It does mirror the serious numbers that we look at from year to year financially. When, for example, much like the government's CPI, the PNC CPI measures a core index up a mere 0.7% this year that excludes the swans. The increase, however, is within the Federal Reserve's comfort range to maintain low interest rates. The cost of the 7 swans of swimming, which generally provides the biggest swings from year to year in the PNC CPI based on supply and demand, rose by 12.5%. Almost double last year's rise of 6.7% to $6,300. That was the biggest dollar increase this year, up $700, a 12.5% boost. I think that the maids of milking, they were held at the same price.
The maids were. We priced them off the minimum wage, so they benefited for 3 years with an increase, and they have not seen an increase for the last 2.
And I believe they're paying more for their health insurance as well. They're taking a bigger percentage. I don't have all the facts and figures in front of me. And they're not going to be happy with their retirement program. But beyond that, I mean, it is what it is. And it's a funny way. Do you remember 28 years ago who came up with the idea this is a good way for us to, in effect, teach children of all ages how this works?
Absolutely. A fellow named Bob Christian, who was our chief economist at the time, came up with the idea. And from year to year, it's grown, and much anticipated now to see what the cost of Christmas is. So this year, the cost of Christmas overall is up 3.5% last year at a little over $24,000. And if you were to buy all the items in the song, 364 of them repeated, it tops $100,000 for the first time at $101,000.
Wow. We mentioned, let's see here, the 8 maids of milking were flat at no increase. That was $58. And then the 9 ladies dancing, that was flat. And before anyone says, wait a minute, the women aren't doing so well, you should know that the 10 lords of leaping also were flat. So it's just the way it has been. The 11 pipers piping up 3%, as are the drummers drumming. But altogether, you say the first time over $100,000. And though if we were going out to buy that, we wouldn't be so happy. But the fact is, we are happy as business people that the price. There is some growth going on here. There's some good health.
There is. We're seeing some pickup in the economy overall, and that's reflected in some of the price increases. But wages continue to be stagnant in a sluggish economy. So we see a number of those service sectors and the labor pieces not go up this year. And that reflects, again, what we've seen in the economy. If you take the wage portion of the employment cost index, it's only up 1.6%. So it reflects what we still see going on in the economy.
It really is, Paul, kind of a fun way, as you point out. And,
yeah.
we're education is really important to PNC Bank. It's a big part of our philanthropy. But also when you think about what's in there, it is reflective of what's going on. I mean, I think that average workers would tell you they're not seeing a lot more in their paycheck over the last couple of years on some of these categories of jobs. And I think it is reflective of what we're seeing out in the economy.
I'm wondering what the biggest surprise is as we look at what in effect is the PNC Christmas Price Index, which is on track with the economic indicators. You'll tell me what the biggest surprise was or is, Jim or Rick. You can, but I'm surprised just glancing at this that the 5 gold rings went down.
Well, you hit on it. That's
the big surprise.
That's a big surprise. So you would think with a record gold commodity prices, you would see that reflected in gold rings, but actually jewelry stores, the demand for gold, people are more selling their gold than they are buying. Demand for platinum and the like is up at a jewelry store. So jewelry stores are pricing those as a loss leader, and gold rings went down in price.
Now that is a surprise.
It does show up at first glance. You think that's counterintuitive, right?
Yeah.
But it does show up as kind of a little bit of a surprise.
And it's interesting, I don't know if it applies the same way, but unintended consequences of a run on gold and everyone hearing about how expensive gold is and kicking themselves that they didn't invest in it and remortgage the house and get gold and all of those things that makes people not want to ask for a gold ring, which then makes the jeweler say, nobody's buying our gold rings, we better do something about it. And it's a wonderful lesson in the way business works. And in these 28 years, what kind of a trend? If you were to look back, Jim, and you would too, Rick, and you have, I know, but after 28 years, has the Christmas Price Index revealed any major trends?
Again, the shift in the economy from goods to services shows up in the Christmas Price Index and the government price index, and we continue to reflect that, and we see that in the economy. And we do see volatility over that time. So there are years where, in fact, some items go up more than others. We see that as we look at the consumer price index, we take out food and energy to get a more stable what people are faced with. So those are the trends that I think continue to show up both in the economy and in the Christmas price index.
Rick, you've seen some of this over the years, and you were just about to say.
Well, and I was just going to say that in Southeast Michigan, we've talked about this before, Paul, the manufacturing sector's kind of led the recovery. But in many parts of the country in the last, especially decade, service jobs have really outnumbered manufacturing jobs. And I think that is what Jim's point is. It's reflective in this index, is we've gone a little bit less on manufacturing and more on service. And that's really what's reflected here.
And as is the market changing before us, and the market responded well. Robust sales on Black Friday. Of course, we had the follow-up on that Cyber Monday, which really has turned into Cyber Week or Cyber Forever. We've seen competition unlike any before. The brick-and-mortar stores are not going to stand by any longer. In Michigan, there's a move afoot to make it more fair and equal, so that the people who are selling on the internet that don't have brick-and-mortar stores here and get a 6% break immediately, that's not fair for the people who here. The people that have mortgages through you, Rick, and are trying to employ people here locally and all of that. What's fair is fair.
The sales tax issue is, I think, where you're going with
right.
that. And it's interesting because in some regions, like in our home region, Pittsburgh, Pennsylvania, does not have a sales tax on clothing. And so that's one that really shows up during the holidays as well, not only online but in the bricks and mortar. If you go into a bricks and mortar here and you're used to shopping somewhere else, you sometimes get quite a shocker, right? Because a lot of what's purchased in the holidays is clothing as well.
And there's no sales tax on clothing in Pittsburgh.
That's in the Pittsburgh region. I don't know, Jim, if that's true in Philadelphia. It's a Pennsylvania.
All of Pennsylvania, huh? Yeah. Where do you make up the money? We're all ears here.
That's a good question. I don't think it's in the alcohol sales, but it may be.
Well, it could be a little bit. There's other things that they have that we don't have here, like state car inspections, and there's revenue there, obviously, and we don't have that here. So I'm not sure that really makes up for it. But
It's a big ticket, though.
It is.
There's a lot of clothing and a lot of money that's generated. We would be in big trouble if that went away here, I think. They'd have to juggle a lot of stuff. Jim, would you say consumer spending is the primary driver of market performance?
it's an important component of the economic performance. I think at the moment, market performance is probably dominated by what we see across the pond in the headlines out of Europe. But the consumer from the domestic economy is no doubt picking up. I don't think it's going to be the component that we saw in the peak in the 2000s, but consumer spending is a pleasant surprise in this environment. We saw some very robust spending over that first weekend in Black Friday. That will likely fade a little bit as we get into the Christmas holidays, but we still expect a 4% increase year over year in retail spending at this time, which is in this environment pretty good.
Ric DeVore, Regional President, Detroit and Southeast Michigan PNC Bank, on our PNC Roundtable. Our special guest, happy to have back James P. Dunigan, Executive Vice President, Managing Executive Investments. And since we have you here, Jim, and Rick, I want to ask him, you mentioned Europe a moment ago. To me, when I read my little business news first thing on my morning show, to me, it's laughable that the market can go up 300 to 500 points one day because, they've got a solution, when I know the next day they're going to say, the solution maybe is not going to work, and it goes down 300 points, and the next day the same thing, and then the next day, Italy's okay, but what about Poland, or what about whatever? This is, you're a professional. This is what you do. Does this at all concern you about the way this market now has become a roller coaster based on maybe too much information out there? Nobody, when we were growing up, you didn't get in a cab in New York City and have a guy go, "Hey, what do you think about the market? Can you believe that thing?" And today, you're paying for your groceries at a grocery store, and the guy checking you out goes, "Can you believe what happened in the stock market today?" And they go, "What the? Are we paying too close attention, or what? What do you think about all this?"
Well, I think there is a consequence to 24-hour news. It used to be, to say 20 years ago, all we had was Wall Street Week on Friday nights, and now we have it 24 hours. And I think it's a benefit and a transparency, but it does add to the volatility. And you're right, the cycle that we've seen of a panic and then an anticipation of a solution and then a disappointment, it continues. I think hopefully we've broken that a little bit with some of the news and activity that's coming out of Europe that can get us away from that. But we've seen unprecedented volatility. If you just measure it by moves in the S&P going up 1% on a daily basis, 37% of the days this year have been up over 1%, up or down over 1%.
So what do you think, Jim, where does this, and there's a better name for it, you'll help me with this, but that the instant trading that's been taking place that we've heard about, where, people punch it into the computer and then the computer does it. Nobody says, we should sell now. It's second by second. It's buying and selling and buying and selling. Where does that come into all of this?
I think you're referring to high-frequency trading.
High-frequency trading.
A favorite topic of mine. I think it has been blamed for a lot of things. There's some positive things about it. Most would say it's probably around improving liquidity in the markets and bringing down trading costs. I'm not sure that bears out in the burdens that it puts on the market in this volatility. So I do think there's some need for regulation there. SEC seems to be looking into it, but I wouldn't count myself a fan. It does add, but it's difficult for anybody to describe where exactly. It used to be that 80% of the trades were done on the New York Stock Exchange. Now there's 50 different exchanges. Hard to tell exactly where a trade gets done and how it gets done. Some would say that you now have uneconomical trades are now economical, and that's a situation I think needs to change. So some improvement in that part of the market.
Again, neophyte, I'm going to just say it, from what I understand for our listeners, so they understand too here on the PNC Roundtable, the high-frequency trading done automatically to the point of that the goal is that the computers, based on whatever it's programmed for, will go in and out of markets in seconds. And the goal, at least initially, at the end of the day, to be out altogether, meaning they go in, they come out. And you couldn't even ask the guys who were running it what they bought and sold that day. They wouldn't have any idea. It was just done. All in and all out, and let's start another day. Is that still the way, kind of, it is?
There's a fair part of that, and those strategies do result in that outcome.
And for those of us who, if we can scrape together some money and we put it into a fund and we're supposed to let it sit there, these guys are spinning all around us, and they've got to be affecting what we do.
Yeah, there's no doubt you can get yourself that it's not a level playing field, or not the level playing field that it was, and I think we need some reforms in order to make it a level playing field. Because your point is exactly at the same time we've added this volatility, we've transferred the responsibility for people's retirements and their 401ks to individuals, and most individuals would say that's not a situation I want to be part of, because I'm not sure it looks a little rigged to me.
Sure.
And I think we need some reforms.
And Rick,
I was just going to add is you have that, plus you have this instantaneous news environment we live in, and it gets the focal point becomes, I think what you're getting at, Paul, in a different way maybe, was confidence. And when you are now managing, for the most part, your own retirement future, if you will, I think that's why it's become such a favorite topic, whether you're in the grocery line or in the line to buy holiday gifts. It's the same issue. And I think the confidence issue then not only spills over from the consumer, but then, of course, over on the corporate side.
Well, what you can do, and Rick on the local level and regional level as president there, you can see how some people, remembering the good old days when they'd bring in their book and they'd make a deposit of $500 and they'd write it in the book and stamp it, and you'd walk away and you go, I got $500, and tomorrow it's not going to be $400. It's backed by the full faith of the government, and that's going to be fine. And have we seen people coming back to a more secure feeling? Now, interest rates are not so good for that, but a more secure feeling of knowing that at least if they put this money here, it's safe, it's going to grow a little bit, maybe not enough right now, plus you have other ways that they can grow with the CDs and with other funds that you offer. Have you seen a little of that when all the craziness is happening on Wall Street?
I think what you're getting at is the psyche of the depositor, and I think there is now safety and principle are of utmost concern to the consumer. Getting a little bit return because the rates are so low is kind of icing on the cake. But we are seeing safety as being an issue. And I don't mean just in terms of insurance from the government, FDIC insurance, but just the safety of the principal, because people have seen not only their homes devalue, but also the devaluation of their retirement assets at the same time, going down tandemly. So it seems to be there's a lot of people just say, if I could just preserve my principal, I'd be probably happy. And it's unfortunate, but that seems to be of utmost concern to folks. And I understand that. I don't know if you're...
They talk about it in return not on my capital, but return of my capital.
Exactly.
Yeah,
That's
really.
a better said.
It's a good point. We used to be concerned about return on it. Now we really just want to make sure we get it, return of it.
Well, it's a very similar conversation you hear people talk when they talk about Social Security. I mean, I run into people all the time who said, if I could just get back what I put in, you don't even have to pay me any return. If I could just get the principal, I would be a happy person.
I've been paying in for a long time. All of us at this table have been paying in for a long time. The idea that we see none of it maybe is disgusting. It is beyond disgusting. But beyond that, as managing executive for investments for PNC Wealth Management, Jim, in following the markets the way you really do, where do you see the markets heading in this new year, 2012?
I think we're going to continue to see a positive trend in the economy. We are recovering. We are expanding. So we're looking for 2.5% growth in the economy and GDP. And I think that filters into a financial performance in the equity markets. It's probably in that high single-digit 9 to 10 to 12%. So in other words, we're about where we started 2011. If you look at the S&P, 1250, 1260, that's about where we started. So we didn't, for all that went on this year, we didn't lose much ground. I often say if you lose $1 6 times, if you lost $1, if you lost $6, it feels like you lost $6, but actually, for all the volatility, we're about where we started. Our forecast for
it sure doesn't seem that way.
Oh,
but it is. I'm taking your word for it.
Well, it's been an interesting ride, hasn't it?
Yeah.
And then if you look at 2012, our forecast for the S&P would be in that 1330 to 1350 range. So that would get you with dividends probably 10, 11% returns against a 0% return in your money market funds, taking a little bit of risk, which I think is what the Federal Reserve and others are trying to put a attractiveness to risk assets. Equity markets look pretty attractive here. Now there's some risk. We'll continue to see headline risk out of Europe. The fact that a deep recession there would in fact alter our forecast, but we're not forecasting a double dip in the U.S. economy. So there's some reason for optimism, but you have to be alert and diligent in what those risks will be out there.
Well, with that thought in mind, Jim, with the risks and the mortgage bubbles, the European debt, not knowing from time to time, the stock market, it seems, can't get a break, and it even has an image problem. If you're telling us we're basically where we started, so it's really not as bad as we think it is, what would it take to get the economy and the markets back on track? And I'm not even sure we know what back on track means anymore, but I'd love to hear what you think.
I think the basis is a confidence issue. So if we continue to see job growth, we are seeing job growth in the economy. We added 120,000 in November. We're looking for probably 150 in December. So we're beginning to add jobs back. That will improve consumer confidence, and that's a key to improving housing. So we have to get housing back. It's sort of stabilized here, but we have to get it to grow.
Let me just make sure I understand completely. We have to get housing back to what?
To a growth. So we need to start adding.
Does that mean we start at our horribly depressed area? And if you, I'll just use figures. If you bought a house for $100,000 and it's worth $50,000, if it becomes worth $55,000, that's a good thing.
Yes,
because it's back on the road
to recovery.
Right. Exactly. But if you add jobs, that means people may move and, in fact, begin to transact houses. So we need to have some housing transactions, prices stabilize to go up. At the moment, the mindset is that housing will continue to go down. Housing prices will continue to go down. So you need to reverse that in order to get consumers to say, now it's time to go out and buy a house, because housing affordability is almost at an all-time high. It's very affordable between... And
the interest rates are at an all-time low.
Right.
So in the good old days, it would be an incredible opportunity for people to go out and buy and do what we all did. Now we've been told wasn't the smartest thing to do, because when we were buying houses, we were told to buy as much house as you possibly can, stretch a little bit because you'll be so...
Right.
Yeah. It's kind of like we're telling people to do that again because of the deals. But yet you're also saying... You might buy that $100,000 house that at one time was $300,000, but there's no guarantee that it's going to go to $105,000. It could go to $90,000.
Well, is
that the consumer confidence part of it,
that's
where
it.
people won't pull the trigger?
And that's the risk of deflation. So deflation is declining asset values, and then people get that in their mind, and they'll continue to think the prices will go down, so they won't buy. At some point, if you stabilize those prices, then they say, affordability, if I have a sense that at least maybe it won't go up, but it's going to stop going down, that's when to decide that now's a good time to buy that house.
Because you think about, the Christmas price index as a metaphor for, consumer confidence, but we're still talking about the same thing, aren't we? Confidence to lead somebody to buy the second house, to buy the first house. And I think that's still the issue. And what Jim is saying is we would just like to see us hit the bottom and start going up. That versus getting back to your $100,000 value. I think you're spot on. We'd like to go from 50 to 55, and we'd be very happy there if that would then continue.
Heck of a lot better direction, that's for sure. So confidence is the word. Do you have confidence? You both are expert in this area. Do you have confidence that this is something that we can affect and fix and change? And if so, do you have confidence that the people that can do that are in the right positions to make that happen?
I wake up in the morning confident. So I think if you look at some of the challenges we've had in Washington, going through the debt ceiling debate, it's difficult to convince yourself that they can support a resolution to support Mother's Day, no less than anything else. So you'd have to say that there's some changes need to be put in place. But I'm confident that without even the support from Washington, consumers are out there companies are out there trying to improve their lot, increase their market shares, increase their profits. So I think businesses have decided they can figure out how to work in this environment. And we see that in the economy, and consumers are doing the same thing.
That's very interesting. Jim Dunigan, with his Executive Vice President managing executive investments for PNC, and of course, our co-host Ric DeVore, who's Regional President, Detroit and Southeast Michigan PNC Bank. It's very interesting because what we're seeing here in Detroit, and you certainly are in the middle of this, Ric, is that in spite of the very severe problems the city of Detroit has and the city management, there's a whole bunch of people, entrepreneurs, young and old, who are looking at this area and going, okay, yeah, we see those problems over there, but man, what an opportunity exists for startup and other opportunities for entrepreneurs to grow in Detroit and throughout Southeast Michigan.
And it's entrepreneurs, but it's also some businesses that are saying, okay, we have 3 locations on the plate for 2012, and you start looking at the side-by-side analysis of the cost, it's a great deal to put a business here. Just if you look at the infrastructure, the cost to acquire the land, to build the building. So I think you're spot on. Getting back to the housing issue, I think one that we're keeping our eye on is with the negotiations in Washington is it going to remain sacred interest deductibility for the average taxpayer on a mortgage? If that were to go away, it seems like that would be yet another body shot in the stomach of housing, and that could set us back. And so that's one that I'm watching closely. I don't want to speak for Jim per se, but that's...
I want to know also what I agree with you, Rick, and I'm wondering if you agree from your executive perch, if you will, across the country and around the world, and if that would also just devastate prices on homes.
Well, I think it would have a dramatic impact. I don't think timing is everything. I don't think now's the time. They'll probably take the first step to eliminate it for high-income taxpayers. But I think for the average American, for the time being, now's not the time. It's probably going to stay on the hit list for a while, but I think everybody's hopefully smart enough that leave that in place.
It could be graduated. I mean, per income. But I'm talking about the family that makes $60,000 a year. I think that would be pretty devastating to take that away from them.
And it can't be done. It's never supposed to have been done in a vacuum. There's supposed to be other changes that happen. So if they say, all right, everyone pays 10%, it's a flat tax, or whatever the percentage is. I'm just saying, everyone pays 10%, and we're taking away that mortgage interest deduction and the charity deductions and all of that. Well, that's a whole lot different than just taking it away and not changing anything else. That would be incredibly stupid, but I'm not here to say that somebody couldn't make that incredibly stupid decision in Washington.
There's no doubt, and that's what often happens. You'll see a headline that's what they're proposing, but you're right. In a vacuum, it would be the wrong thing. I think most people would agree that we need reform on our general tax code. When and how we get it, that will be probably after the 2012 elections before we really tackle that. But there's enough incentives and disincentives that cause so much of the volatility. I think we need to take an opportunity and reform the tax code, but it's a difficult thing to do.
But Paul, I think you just hit actually on a huge issue, which is in and of itself, if that went away, that would be bad, and that might be the only thing you see on the news bite, right? But if it was done in the context of some other overhauling, a lot of people might say, "Hey, I'm okay with that."
In the end, it's not so bad.
But the news flash could be, "Oh, it's going away."
Right,
and then the CPI index goes down.
It goes back to what Jim was talking about at the beginning. This 24-hour news, and they have to make news, and unfortunately, bad news seems to sell better than good and positive, or even honest, straightforward, realistic, full-story news.
That's true.
Exactly,
it's a problem.
The challenge is everybody seems to come up with their own set of facts. So you might have your own opinions, but you can't necessarily come up with your own set of facts.
Shouldn't be able to. And with that thought in mind, coming into this presidential election, in the past, every party has been, I hate to use the word guilty, but I'll say guilty of it. They do certain things to make them, to prop themselves up and look good to get reelected. It almost seems like that's not terribly possible right now. I mean, I don't know what the administration...
To make themselves look good?
Right. I mean, I don't know. I don't want to be political here. I'm just saying that I don't know what could happen in this short period of time that could sway an election the way it's been done in the past.
It's a good point, because we don't seem to have the traction on the economy. Jobs may pick up, but I don't think enough to make that a real headline by the time we get to the elections next year. So if unemployment stays over 8%, that will be a challenge. If we're not seeing real traction on jobs, or if by some chance we slip back into a decline in economic activity, even a mild recession would be a challenge.
So to both you, Rick, and you, Jim, are companies sitting on this almost mythical hoard of cash that they don't have confidence to use to build the new plants and to hire new people and to do things with that money that generally are the engine of the economy? Is that true, or is that kind of blown out of proportion?
Well, maybe I'll give you the Southeast Michigan view, and I'll let Jim maybe tackle the national issue. But what we've seen here, Paul, is this year, in my opinion, has been kind of two different years. The first 6 months were, I think, by Southeast Michigan standards, robust. The second part of the year, especially in the summer and into September, seemed to be pretty stagnant to us. But now we're seeing some companies have said, look, at some point I have to replace my equipment. If you look at their capital expenditures and you look at the lack of investment back in the firms for the last couple of years, at some point this is wearing out. I'm talking about manufacturers. And now they're starting to say, okay, I don't really like what's going on in Europe. I'm not sure about Washington, but I got things that are breaking down. And we're seeing orders of equipment going up. So at some point you just have to start, putting a new line and putting a new equipment in. So we're starting to see that, which gives me cautious optimism for the first part of the next year. But that's kind of a Southeast Michigan view. I don't know if
it is true that corporate balance sheets are in almost pristine condition. So companies have taken advantage of low rates, refinanced, put cash on the balance sheets to eliminate the volatility and the uncertainty that they saw. Now, making that investment decision will be the next point. To Ric's point, we are seeing loan demand pick up. We are seeing a pickup in business investment, plant and equipment. There's no doubt that some of the uncertainty out there, whether it's the economic uncertainty or the regulatory environment, have dampened that. But I think companies are beginning to say the environment's going to be the environment. I have to make decisions. We have to return money to our shareholders. We got to figure out how to survive and operate in that environment.
Final word from both of you, gentlemen. I mean, here we are, 2011. We've just we've been on this roller coaster ride in the market for investors. I'd love to hear from both of you just the final word from you on what you feel the course of action you might recommend in these times of financial turbulence that are not at the end yet. The roller coaster continues into 2012.
Well, I think in low rates in this environment, I think you have to look at risk assets. So I would suggest that investors, within their risk tolerance, take that opportunity, whether it's even a first step into dividend yielding stocks, better than 0% in cash, because that's going to be at low levels for some period of time. So I think there are opportunities out there. The environment is improving. And I think as we get through the elections, we're going to see an opportunity. Much of the debate around the fiscal policies in the U.S., I think, will come to a head, and we'll see some progress there. So I think it's a year of some optimism and an opportunity for people to make some investment decisions that will be right for them, but likely we'll still continue to see some volatility around that.
Partner, final word?
Well, I was just going to piggyback on what Jim said, and that is that what was hidden in that message, maybe or maybe not so hidden, was the issue about prediction of interest rates. And I think we're seeing they're going to be low for some time. Seems like bonds are not a good idea, and certainly cash isn't a good idea. So I think it's the issue of putting some allocation into the equities that have, good dividend yield. And I think that's the same that the corporates are looking at. I mean, with this cash, what are they going to do? Buy back their stock, have a special cash dividend, or are they going to start investing back in their business? So it's a similar thing that we're seeing there, which is we need to go out and invest for the shareholders. And I think the consumer needs to go out and invest for themselves as well, and it's probably in the equity side.
I feel like I'm in the film The Graduate, but I'm not going to say plastics, but I'm going to say IBM. Who'd have thunk it? Today, IBM, once written off, doing extremely well. You got Buffett putting $10 billion into it. He's not stupid as an investor, and they pay a 1% or whatever. They pay some kind of a dividend. It all comes back to one of the old standbys, Big Blue.
There's no doubt. In innovation, they figured out how to rework themselves and innovate.
Right. Did a great job.
It's at the heart of what makes us great.
James P. Dunigan, nice to see you again. Thanks for coming by. Jim is the Managing Executive Investments, Chief Investment Officer for the PNC Asset Management Group, and, of course, our co-host, Ric DeVore, Regional President, Detroit and Southeast Michigan, PNC Bank. Merry Christmas, Happy Holiday, and Happy New Year, and may 2012 be increasingly, slowly but surely better for all of us.
Thank you.
And
Same
that
to
way
you.
I don't want that one day up, one day down, one day up, one day down thing. We don't want that.
Same to you, Paul.
On behalf of our guest and our co-host, Ric DeVore, regards, Paul W. Smith.